You are listening to the Mining Stock Education Podcast, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
For my general investing philosophy of finding companies that generate cash and successfully redeploy that cash, the resource business is really terrible from that standpoint, and it's highly speculative. So my approach is really a barbell approach, and I want to put most of my capital into the royalty and streaming companies, and I want to favor the larger companies that have diversified portfolios that have a very low cost of capital.
Thank you for tuning in to Mining Stock Education. Ladies and gentlemen, I'm Bill Powers, your host. If you want to engage the show, feel free to reach me at bill@MiningStockEducation.com. Well, our guest today is Mr. Ben Kramer-Miller. He is here to share his approach to resource investing and provide his take on the sector as it currently is. He is the owner and manager of MiningWealth Capital. He previously has served as the chief executive officer of a privately held exploration company, as well as being a consultant to Nevada Gold Corp. He's also been a mining analyst and a freelance writer in this sector, so quite well-versed. Ben, thanks for coming on Mining Stock Education, and could we kick it off with you sharing a little bit about your background and how you came to focus on the mining sector?
And just one quick correction before I get into that. It's not Nevada Gold Corporation. It's NV Gold, which is a venture listed company, NVX. But aside from that, accurate. Thanks for having me on your show, Bill. I've been investing in resource stocks going back to 2008, 2009, when the global financial crisis was happening, and I had planned on going to grad school for philosophy, and that's what I got my degree in. And I sort of started investing as a hobby on the side, and gold seemed like a good investment. And it seemed natural to look at gold miners as a way to get leverage. I know better, but I'm self-taught in the business. I've been investing. Going back to 2008, I started writing on the sector on Seeking Alpha back in early 2013. And, around that time, Seeking Alpha had expanded significantly the pay packages for its authors. And so I became a full-time writer on Seeking Alpha, writing about predominantly gold stocks. In 2015, I cut that considerably to focus on a pay-for newsletter focused exclusively on junior resource stocks. Unfortunately, the timing was not good on that, and I had to shut that down towards the end of 2016. In 2017, I started doing some IR work for companies, and I've done work for Desert Gold. I've done work for NV Gold, as I just mentioned, and most recently, I did some work with a company called the Morocco Resource Corp.
Did you teach yourself geology then, if you're a philosophy major? I mean, all the geology just came self-taught?
So I was a very good science student, and I'm probably better at the chemistry and the physics side. And the great thing about geology is that all these things kind of come together. And you have these notions in chemistry and physics that enable you to understand certain things in geology on an applied basis. So I try to teach myself geology. I read geology textbooks, but I have a network of people who I consult who are trained as geologists. In helping me make my investment decisions.
And then you're currently the owner of MiningWealth Capital, and what is that, a investment fund?
So right now, MiningWealth Capital is predominantly focused on a privately held portfolio that has probably 10 to 15 projects or interests in projects. Two of them are relatively advanced and have in-house resources. And so right now, MiningWealth Capital is really focused on evaluating that property portfolio, seeing if we can find a way to create value and hopefully go public with the more advanced properties in the next several months.
So you've been in this sector for over a decade. Could you elaborate a little more on your investment approach and the positive investment criteria that you look for in an investment?
Generally, when you're looking at investments, my main concerns are how much cash is the company generating and how is management deploying that cash. So, I think with that in mind, I tend to favor the royalty and streaming companies in this space. Mining companies tend to perform very poorly and are generally poor stewards of capital. So, if you're able to time, the gold market or another commodity market successfully, then you can do extremely well in mining stocks. But if you look at the well-known names in the sector like Barrick or Kinross or AngloGold, these stocks are trading below where they were in 1999 when gold was sub $300 an ounce. So that's something really worth considering before putting money into mining companies. And I would be very selective on those companies. Now, also with respect to junior companies, keep in mind that their source of capital isn't from cash flowing assets; it's from the capital markets. And furthermore, it's not easy to quantify the value that is being created by junior mining companies or junior resource companies who are effectively collecting data. And so you can estimate roughly after a certain point what a property might be worth once it gets to the PEA or the PFS stage. But other than that, it's very difficult to understand what the real value of these things are. So from my general investing philosophy of finding companies that generate cash and successfully redeploy that cash, the resource business is really terrible from that standpoint, and it's highly speculative. So my approach is really a barbell approach. And I want to put most of my capital into the royalty and streaming companies. And I want to favor the larger companies that have diversified portfolios, that have a very low cost of capital. And, then on the other side, really take that risk on the juniors or the mining companies, knowing full well that, in a general sense, the odds are against me, and I can try to mitigate that through some of the knowledge that I've gained over the years and my technical contacts. But I think it's key that that investors understand that these are that mining companies and the junior resource companies are extremely risky. They tend, in general, they don't make money over time. And you need to be incredibly selective and, have small positions, basically.
What's the breakdown between royalty companies, producers, and these pre-revenue companies in your portfolio, percentage-wise?
I would say probably 90% would be in the royalty streaming companies, and then 10% in the in the juniors. I don't currently hold any gold mining companies, any producers, or anything that is near production. I own one mining company, which is Alliance Resource Partners, which is a coal miner that trades at like 4 times earnings, and I'm a bag holder in that one. I'm down 75% on that one. So.
I've noticed that you also have on Twitter seem to like Sandstorm. You've posted a couple positive things about Sandstorm. Sandstorm, I don't know what the market cap is as we speak, but it was around $1 billion market cap. Are you positioned in any of these smaller royalty companies, half a billion and below?
So first, with respect to Sandstorm, so yeah, Sandstorm is my largest position. I started looking at Sandstorm back in as early as 2013, and I was quite negative on the deal relative to the other royalty companies out there. And the reason for that was they typically had very large royalties or streams that would take a punitive amount of capital away from the mining companies that they were partners with. The partners were relatively small companies, and the team made a lot of technical errors when they first started. And over the past few years, they've really turned the ship around. And now, if you look at their major partners, it's not Colossus Minerals, Brigas Gold, or Arizona Mining. It's Rio Tinto, it's Lundin, it's Yamana, billion-dollar companies that that have diversified portfolios and who really understand how to operate mines. So they've really turned things around. They've also been punished for their purchase of a company called Mariana Resources a couple of years ago. The reason for that is that this deviates somewhat from the royalty streaming model. Mariana was developing the Had Maden gold project in Turkey with a local Turkish partner, and the market really punished it, despite the high quality of that project. And I don't know of any other project out there that has the economics of the Had Maden project. So it was an exceptional move on their part, but I think it was a good one. And the stock just got hammered, and that's when I started, picking up shares. And then last year, when the stock was trading at $4 and below that, I made it my largest holding, and so far that has worked out relatively well.
And the smaller royalty companies, the Ely's companies that far low in market cap, do you go into those as royalty companies?
So I don't, and there are a couple things there. So first off, these smaller royalty companies, there's often other facets to the business model. So if you look at Ely Gold, they have a lot of exploration properties in the portfolio, and it's very expensive to hold on to these properties. Another thing that I think is critical in terms of understanding just why the larger players have an advantage is their cost of capital. The royalty companies have a very low cost of capital. They can borrow money in order to buy these streams, and they can justify paying higher prices than the smaller players who do not have access to that inexpensive capital. So companies like Metalla and Mavericks have been using their stock as a way to grow their portfolios, they've also been making smaller deals with smaller partners. And it just doesn't appeal to me the same way. One exception, this is largely because of the success that the company has had, is a company called EMX Royalty, which is kind of one of those hybrids between an exploration company or a project generator and a royalty company. And these guys have proven that they can operate on both sides. They've purchased royalties that were undervalued, and they have also successfully generated projects. So if I had to buy one of the sort of smaller royalty companies that is a hybrid, I think EMX would be the way to go. But I would still categorize a company like that as a risky junior, and I would weight it in my portfolio accordingly.
We'll be right back after this word from our sponsor. Otis Gold Corp is a gold development and exploration company with quality projects in the pro-mining state of Idaho. Otis's flagship Kilgore project has a resource of 961,000 gold ounces, and its recently published preliminary economic assessment demonstrated an impressive post-tax IRR of 53% at $1,500 gold. In addition to the significant expansion potential at Kilgore, Otis is exploring its highly prospective Oakley project. This Carlin-type gold deposit already has an inferred resource, and previous near-surface drilling intersected 123 meters of 0.69 grams per ton gold. Otis Gold Corp trades in New York under the ticker OGLDF and in Toronto under the ticker OOO. That's triple O. To learn more, go to otisgold.com. That's otisgold.com. For the 10% of your portfolio that focuses on the higher risk, higher reward stocks, what are your investment criteria here?
So, I think the key is really management. And, this is something that, I don't think a lot of people understand. And it's very easy to say, I'm looking for, companies that are run by management teams or individuals that have had industry success. And the problem with that is it's very easy for individuals to claim industry success without actually having had it, especially since real discoveries, real breakthroughs in this business are scientific, and a lot of scientists are introverted. Some of them have trouble speaking up for themselves, and people who are more extroverted and who are more politically motivated and more focused on getting up to the top than being a scientist, are people who are can get credit for these discoveries. So I think management is key, and it's less about somebody having claim to industry success, and more about me getting to know the management team and developing a level of trust and a rapport, just making sure that that management is aligned with shareholders, and that they have the technical expertise and the capital markets expertise, as well as the network within the capital markets, in order to achieve their goals.
Ben, is your favorite jurisdiction Nevada because you have done work there?
So I would broaden that to the Great Basin generally, and that goes north into Idaho, east into to Utah and Arizona. The reason I'm so focused on Nevada, and it is a great jurisdiction to work, but the reason I'm focused there is simply that my network of geologists have expertise in Nevada. They've worked there. They've done research on a lot of these properties, and so that I believe gives me an investing edge that I think would be very difficult to attain if I were to look at other jurisdictions that investors tend to like Quebec and other parts of Canada, where I don't have that network. So that's really the key for me in investing in Nevada. But that doesn't mean that it's not without its issues. And a couple of those are that land is it's expensive to hold. So a lot of exploration companies you see who are in parts of Africa or Latin America or Canada, you'll see that they have 100 plus square kilometers of land, whereas in Nevada, if you're a junior, you simply you can't do that. The other disadvantage to Nevada is just the lack of access to data. And in Canada, for instance, data is available. It's publicly available. Whereas data in Nevada is it's hoarded, and there's a level of I guess it's coveted, and it's secret, and you simply have to be more of a detective in order to succeed in Nevada. Whereas if you want to do something in Quebec, you can just go online and find all of the data. You can find exactly where all where there's land available. Those are a couple of disadvantages, but the advantages to Nevada are first of all, it's highly geologically endowed. There are multiple mines in Nevada that have produced north of 10 million ounces of gold. The Gold Strike mine has produced 44 plus million ounces of gold. That number is probably 45 now. The second thing about Nevada is the laws governing how you get your permits are very straightforward. That doesn't mean that they're simple, but they're very straightforward. And if you are meticulous and you follow directions, it's not difficult typically to get an exploration permit in Nevada.
What's your expectation for the gold mining sector over the next 3 years?
Yeah, it appears that gold is in a bull market, and the gold market bottomed in December of 2015. Incidentally, I wrote an article, about literally the day before, arguing that this last dump in gold is it, and it's time to buy. And so far, gold has risen about $400 since I made that call, and it's been slow and it's been painful. And you've seen some miners perform relatively well, but a lot of them are still struggling, and a lot of companies are still struggling to make money even at $1,450 gold. Yeah, I guess over the next 3 years, I do expect the gold price to rise. It's not going to go up in a straight line. At some point, the gold price will enter a mania. Whether that happens in the next 3 years, I really don't know. But I think from an investment standpoint, if you like gold, I think you should buy gold. Don't try to buy miners as a proxy for gold. If you're buying a gold company, make sure you're buying it because you like the underlying business, and make sure that the company can succeed in a neutral or a slightly bearish market in gold. Look, if gold starts falling off a cliff, none of these companies will do well. That's just the reality. But there are companies out there where I think you can make money over the next 3 years, even if gold stays where it is or trends slightly downward.
When you look back at the last gold upcycle that you were part of from 2008 through 2012, what would be some of the key mistakes that you would observe, both as an industry as a whole, mistakes of other investors, and your own mistakes?
So I think in any bull market, not just gold, but we saw it in the .com bubble, and we're seeing it today. You see a disconnect between fundamentals and reality. So in a gold bull market, you can have ATAC resources go from 10 cents to $8. I forget the exact numbers, but something to that effect, based on simply a concept. You can have a Newmont buying out Frontier Gold for $2+ billion, or I think it was $1,000 per reserve ounce. something outlandish like that. I mean, similarly, though, in the dot-com bubble, you saw Time Warner by AOL. So you see this disconnect between fundamentals and reality, and if you are a nimble trader, that's something you can take advantage of. So some of the best performing stocks during that bull run are companies that have projects that don't appear like they'll ever be mines. So I mentioned ATAC earlier, which has come right back down. International Tower Hill, which has the Live and Good project up in Alaska, which is there's a lot of gold there, but it's very low grade and it's remote. So owning something like an International Tower Hill during an upcycle, if you can trade that correctly, you're going to do much better than owning a Franco-Nevada. But if you're investing and you're over multiple cycles, Franco is going to compound your capital, whereas something like International Tower Hill is gonna have that 20, 50-fold run, and it's just going to come right back down. So it really depends on your disposition as an investor. Do you want to buy shares in a company and put them in a drawer for 10 years or 20 years? Or, are you a trader? Are you willing to, take advantage of, short-term moves in the market?
Are there any other companies that you're invested in that you'd like to share?
Yeah, I think so. So I did already mention Sandstorm Gold. And another company that I'm invested in, and full disclosure, I did work for these guys. I was paid by them, no longer, but I was paid by them, and I still have options. Is a company called Oroco Resource Corp. So I like to find stories where there is a disconnect between fundamentals and market perception. And Oroco has let's call it a complicated earn-in agreement on a porphyry copper project in northern Sinaloa in Mexico. And this property was drilled out. Metallurgical work was done in the 1990s, and ultimately the project entered an ownership dispute that ended in let's call it April of this year. So here is this. It's a high quality copper porphyry mineralization at surface. The previous previous drillers only drilled down to 300 meters. The average drill hole is, I think, less than 200 meters. And the reason for that is they were looking for oxides, and they didn't find them, but they found plenty of sulfidic material, and it consistently, is grading 0.4, 0.45 copper. And there's already, some billion tons of known ore. The deposit is open to the north. It's open at depth, and the market. The stock has done very well. It's probably one of the best copper stocks year to date. But the share price has come down from its peak. It's lost more than half its value from the peak, and I still think there's significant value. And there are very few copper porphyries out there where the deposit is at surface, where you have very good metallurgy, where you're very close to infrastructure and a port. So I think this is a still undiscovered gem that investors should take a look at.
Ben, if listeners want to follow you and stay up to date on your current thoughts on the market, how would they best do that?
Right now, it would be via Twitter, and my handle is @thewealthminer.
Okay, at the Wealth Miner on Twitter, Ben Kramer-Miller. Ben, I really appreciate you coming on Mining Stock Education and sharing your insights. Thank you very much.
Thanks a lot, Bill.
Thank you for listening to Mining Stock Education. Please subscribe and share this show with like-minded investors. Connect with us at MiningStockEducation.com and sign up for our email list to stay in touch. Much success to you as you learn about, invest in, and profit from mining stocks.
The mining business is one that generates gigantic wealth. You know, a good drill hole that converts might cost $50,000 or $100,000, and it might discover something worth a couple billion.
There is no sector that I know of that has offered up as many predictable circumstances where there was the possibility, certainly not the certainty, but the possibility of 10-for-1 returns, as there is in small cap and micro cap mining stocks. Concomitant with that, if you don't do the work, or even if you do the work and don't discipline yourself on the sell side, there are very few places in the world where you can lose as much money as quickly as in mining stocks too.
I just started to study up on mining stocks, and I just became fascinated because this is such a tiny sector and it's so volatile that either you could do really well, or you could pretty much get blown out of the water really quickly.
The mining sector is a very risky sector. It can take your money very, very quickly. Don't fall in love with stocks. Don't be overly confident, and just do your work as best you can. Do your very best, but don't fall in love and don't get too overly confident, because that's a recipe for disaster.
I have met professional retail investors that have made a tremendous amount of money on the junior mining space. Some of them aren't accredited, and they spend their days researching, talking to people, being on the phone, pouring through financial documents, but it requires commitment.